think what people don't necessarily think about or appreciate is if we go into recession, the $2 trillion deficit, what happens to that, right? Revenue comes down even further, right? And so you get 3, 4 trillion. And so the supply of treasuries is going to explode at a faster rate once you go into recession. So everybody who's thinking that, okay, recession means economy is going to slow and interest rates are going to come down, could be in for a major surprise if recession actually means deficit blows out even wider, treasury supplies grow dramatically, and interest rates actually go up in the onset of recession. That's the thing I think I'm worried about the most right now.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. When the game changes, the old rules don't apply anymore. And to succeed, you need to adopt a new playbook. Well, there's a good argument to be made that the investing game board has materially changed in the post-COVID era. But so far, both Wall Street and regular investors are still playing by the old rules. Is this a recipe for disaster? To find out, we've got the good fortune today to hear from Jesse Felder, founder and editor of the Felder Report, a highly respected market research firm. He's written a lot lately on the sea change the economy and financial markets have recently experienced. We'll ask him what the biggest implications will be and how investors should adapt to them. Jesse, thanks so much for joining us today.
Adam, it's good to be with you. Thanks for having me.
Hey, it's always a total pleasure to have you on the channel. Welcome to the new channel here, Thoughtful Money. Great to have you amongst the early guests here. You are definitely at the head of that panoply of great experts that we've had on here, Jesse. So very, very grateful that you've made the time for us here. Look, I got a lot of questions for you based upon your recent comments about the sea change that you're warning folks about. Real quickly, before we dive into the specifics of that, can we just kick off with the general question I like to ask here at the start of these interviews, which is, what is your current assessment of the global economy and financial markets?
Well, it's a good question because I think there is a disparity between the trajectory of the economy and what markets seem to be pricing in. I can't remember who said it last week, but there was a quote that I heard a guest on Bloomberg say that markets have essentially priced in soft landing nirvana, and I think he was coming from a bullish perspective. Obviously, that he thought that the recent data justified this idea of soft landing nirvana. And to me, that you hear of markets that are priced for perfection. Well, a market that's priced for nirvana is an even different thing. And there's that sets up a lot of room for disappointment, right? And so I think that's where we're at, where markets have fully discounted the soft landing idea that the Fed has raised interest rates without creating a recession and without creating any real financial turmoil in the process. And so I think there's potential to fail on both points of that soft landing I guess thesis. One would be that it's very possible that the inflation battle is not yet won. We've seen, I think it was John Authers pointed out that markets have priced in, I think this is the 7th time markets are trying to price in a Fed pivot over the past, since they started hiking interest rates. Maybe 7th time is the charm. I don't know, but there's I think still a good chance, especially with what you see inflation expectations doing, that the Fed's job is not done yet. And I think Jay Powell's been very clear that this higher for longer is what they intend to do. So we could miss on the inflation side. Inflation might not come down back sustainably to the Fed's target without more in terms of monetary policy, and more could just be disappoint the markets in terms of not being able to pivot, having to maintain higher interest rates and maintain quantitative tightening for a longer period of time. I think even more likely is maybe we fail on the economy side, where instead of a soft landing, we do get a recession. And there's all kinds of things that point to that. I mean, we're right in the time frame now where you would expect the lags of monetary tightening to start kicking in. And there are all kinds of leading indicators that have suggested that we're headed for a recession. Obviously, third quarter GDP was a strong positive surprise, but it looks like, especially, I listen to or read through a lot of, conference call transcripts and things, and there's a lot of companies that are starting to disappoint on the revenue side. And I mean, Apple was a real notable one. But it was just one among many that are talking about, I think even Bloomberg pointed out, the number of companies pointing out weak demand going forward hit a multi-year, multi-decade high. That, that's, I think, a pretty good sign that there's risk to the soft landing narrative on the economy side. So I think markets are priced for the soft landing nirvana, and that might not be what we get over the next few quarters.
Okay. Guys, there's so many directions I want to take that. I want to dive into reasons for why inflation may stay stickier for longer, causing the Fed to be higher for longer. Obviously, I want to get your thoughts about odds for a recession here, and this rash of disappointing guidance definitely doesn't mean we're going to have a recession, but it's definitely something you would expect to see potentially heading into one. Real quick, though, I want to get to your comments there about this sea change, and I believe you've been putting those in quotation marks in your recent writings, and I believe that's because you're pulling the term from Howard Marks from a letter that he wrote, I don't know, it was like a year ago, 8 months ago. And let me just go through the bullets of what Howard Marks listed when he talked about the sea change, and I'd love for you to kind of just react to them any way you like. Basically, he says, look, if we are exiting an era of declining and or ultra low interest rates, which is pretty much that was the path from the interest rate heights of the early 80s until basically December of 2021, right? Was this disinflation of the interest rate, right? Just steady tailwind at the back of bond investors and anybody that wanted to raise cheap capital, right? He believes that era may be over. We've maybe hit a inflection point, and things are going to be different going forward. If that's true, he says, then we need to begin to expect and price in slower economic growth, lower profit margins, higher default rates, less reliable asset appreciation, a rising cost of borrowing, investor psychology that will no longer remain, quote, uniformly positive, and that financing will be harder to obtain. And in essence, he said, more kind of like normalcy, like the way the world used to work before we had all this intervention on the central bank's part, monkeying around with interest rates. So I guess first question is, I'm assuming you've been talking about this sea change a lot because you think there's something to it. And if so, like, what are the implications of all this?
Yeah, well, I mean, I'm glad that you ran through all those points, because yes, I have pulled the term from Howard Marks, but I think there are just a number of very successful, very experienced investors that have been kind of singing this same song and pointing out this same issue, that what has worked over the last 15 years in the wake of the great financial crisis is not necessarily what's going to work for the next 10 or 15 years. And it comes back to those dynamics that have shifted so dramatically, right? The downtrend in interest rates, but it's the shift in inflation also. And I come back to kind of three main things that I'm looking at, and one is basically just globalization, right? What drove the disinflation, I think, over the last 40 years was the trend to bringing costs down by offshoring labor. You also had demographics with the baby boomers coming into the workforce. So you had a huge kind of positive supply shock with so much labor, coming in, baby boomers coming in the United States, and then also this huge new labor force that companies taking advantage of in China, whatever, and brought the cost of production down dramatically for all kinds of things. To the extent that now the baby boomers are retiring And we have a shift here in the demographics in the United States, where you have a shrinking workforce relative to the overall population. Goodhart and Pradhan's book that came out about a year ago really does a great job at discussing the demographic side of this. But it's also the globalization side, where companies are realizing the risks of offshoring all production to China, and pharmaceuticals and semiconductors and all these kinds of things, and it creates real risks to the business, and then also to national security. And so we have this trend towards a deglobalization, and that is a major sea change. That's a huge reversal in the cost of production. And so these two kind of disinflationary forces of demographics and globalization have reversed course, and they're now both supportive of inflation in a secular way. So not just cyclical forces, but over the longer term. And then when you add, I think, debt dynamics on top of these things, people like Ray Dalio and Bill Dudley, former head of the New York Fed, have warned of this growing imbalance in the supply and demand for treasuries. And the widening fiscal deficit is also, I think, an inflationary dynamic. So when you put all three of these things together, it really, to me, suggests that the longer term fight against inflation is far from won. And so you have to think about, okay, well, if all these investments that worked in a disinflationary environment, now that the background has shifted from disinflation to structural inflation trends, you have to think that it is a sea change for investors, and completely, as you said, changes the playbook to where I have to find things that work in a different environment now, because what's worked over the last 10, 15 aren't going to work. And, they're not going to have the tailwinds that drove asset prices for the preceding decade.
All right, I want to talk about all those if I can. And Jesse, thanks for being my guinea pig on this new StreamYard service we're using here. I normally use Zoom, so I'm trying to do some stuff on the fly in the background while you're talking here. Well, let's try this one. So on globalization, there are, obviously that is to a certain extent now going into reverse, right? In the post-COVID, post-Ukraine era. The world is sort of starting to fracture a bit, right? Becoming much less unipolar. Countries are beginning to say, hey, maybe we've become either too dependent on supply chains that prove to be very efficient but very unresilient, or maybe we had alliances that we didn't realize could burn us as badly or turn on us as quickly as we're seeing happen to some other countries around the globe. And so everybody is sort of looking out for themselves a little bit more here, right? So Citadel founder Kid Griffin recently said that the world is facing unrest and structural changes that are pushing it towards deglobalization and causing higher baseline inflation that may, quote unquote, last for decades. And you recently tweeted out this chart here showing that globalization is indeed, the chart's titled Globalization Has Slowed. I would actually probably title this thing like globalization is actually starting to shrink. So how big of a trend change is this?
No, I mean, I think it's as big as they come, right? I think we probably underestimate, when you have these trends like globalization that last for 40 years, where we're offshoring production of all these different things overseas, you just become, that's the water that we're swimming in. We don't really notice it anymore. And so when it shifts, people don't necessarily notice the shift right away. It takes time for these things to play out. And I think that's where we're at with inflation, is people think, okay, we've had this cyclical shift in inflation that was magnified by all the unique characteristics of the pandemic. But I think what's gone on under the surface is this inflationary shift with deglobalization and demographics that people haven't really noticed that side of it yet. And I think those are the far more important drivers. And so, you could just take something like semiconductors are maybe a good example. And I think, we're basically investing massively in production of semiconductors here in the United States, which is probably really a good thing for national security, and it's probably a good thing for consumers, because we're going to be creating a lot more semiconductors. So you're really boosting the supply of these things. But what I don't think maybe investors appreciate is that it creates, and actually, CEO of NVIDIA and other major semiconductor companies have warned about this, that if demand stays the same, and globally, China is investing massively in production of semiconductors, the United States is investing massively in the production of semiconductors, you have huge supplies coming online, and demand isn't really changing as dramatically. That's not bullish for prices going forward. So we might be over investing right now, and that's usually what happens, right? I mean, one of my favorite things to kind of look at, and I think this is really important part of this discussion, is just the capital cycle, right? When money goes into a sector, it usually creates a lot of overinvestment, and then you get a bust or a crash in prices. We saw this in the energy sector, through the financial crisis. Fed cut rates to zero, corporate debt costs came down very, very low, and it allowed the fracking companies to massively overinvest in the production of oil in the United States. What happened a few years later? The oil price crashed in 2014. And then, so since then, these companies have essentially been starved of capital because investors have been burned so badly. They go, okay, we don't want to invest in energy ever again. And then you have the ESG movement and all these things. And so these companies literally don't have the funds to invest in production. And so now the trend is that, we're probably underinvesting in energy production. And it should be bullish for prices for a period of time, which is one reason I've talked about for a few years now, the idea of another commodity super cycle. So what we've done on the flip side, though, is in the wake of the dot-com bust in the early mid-2000s, we probably underinvested in technology for a number of years. And that's created, set the stage for this huge boom in technology now, where we're undersupplied and demand or we have been until now. But I think now we're at the point with technology where we're potentially massively overinvesting in things like semiconductors. We're massively overinvesting in startups. And I think for the last 5, 6, 7 years, this has been the case, which is why you're seeing so many of these starting, electric vehicle startups start to go bust. Stock prices down 80, 90%, because we've overinvested in a lot of these things. And I think that's potentially the case right now in semiconductors. I think it's the case probably in cloud and in AI. Just so much money is going into the sector that returns have to come down over the next few years. And this is, I think, something people don't appreciate. This is one of the first areas where big tech companies are competing directly head to head, right? Until now, they've each kind of had their own niche where they haven't really been competing with each other, and that's preserved profit margins in their, in specific niches. But now that they're all investing massively and competing head to head, returns in a lot of these industries are going to come down. And just from the standpoint of the capital cycle, so much money going into these things, that future returns have to come down. And I think that's the point that I'm trying to make, is that we're at a new super cycle for commodities because the underinvestment has been so significant. And the overinvestment in technology and similar things is going to potentially create a number of years, like we saw in the wake of the dot-com bust, where you're going to have disappointing returns on investment from those companies.
That's a great point about the competition, the direct competition in tech. I think that's something that's really pretty underappreciated right now. And you're tying together a number of different threads that a number of different experts on this program recently have been raising. One, we've had folks like Rick Rule and Tavi Costa on the hard asset side, the natural resources side, really waving just a massive warning flag about the underinvestment in many different commodity sectors in terms of the lack of CapEx that's gone into those sectors, either because management has decided that they want to start returning, higher dividends to shareholders, but mostly because things like, the administration has been making it a lot more uncertain as to whether, with the long-term return on their projects that they would invest in today, is going to be. And this isn't anything new. I'm not beating up necessarily on the current administration. A lot of these issues have been going on for years, if not decades. And guys like Rick say, even if demand were just to be flat going forward from here, we're going to be entering like real structural shortages in a number of key commodities based on investment decisions that were made 10, 15, 20 years ago, right? So we've got all that ahead of us here. At the same time, everybody is in love still with big tech, and it's been the Magnificent Seven that have rescued the markets this year, driving everything up with it. They were the FANGs is what powered everybody up, for much of the past decade. Now it's the Magnificent Seven, kind of a rebrand. But I just interviewed Fred Hickey on this channel just a couple days ago, and he's famous for writing his newsletter, The High Tech Strategist. He's been following these companies, these types of companies, since the 80s. And he says he's almost never been sort of as short-term bearish on the complex as he is right now. You're raising something that's more of a midterm risk than what Fred's waving. But the point is there's a ton of faith in the generals right now, the companies that have really been responsible for driving the market indices higher. Fred sees some real short-term risk. You see some longer mid to longer term risk as they begin to compete with each other more directly, and the profits get competed away. Again, I guess a good term to describe all this are sort of like sea changes, right? It's just it's opening the door to a future that we haven't seen for so long, that for most investors today, it's going to be like terra incognita.
Yeah. Well, I love Fred's work. I mean, I read his newsletter monthly, and I think he is, he made some really interesting points through the pandemic about how, it was very similar to the 2000 experience, where in the lead up to the year 2000, right? Not a lot of people remember we had this Y2K scare. And so a lot of companies upgraded their servers and computers and everything in 1999 in anticipation, or I guess in worry about that, things were going to stop working when the calendar rolled from 99 to 2000. It sounds silly now, but those are real concerns. And what they led up to was a big glut of demand in the wake of that, right? So everybody upgraded all their stuff.
Well,
And
they
then
pulled
after
demand several
2000,
years ahead, right? So
was that?
they pulled demand several years
Exactly.
ahead.
They
Yeah.
pulled it forward, and then left a vacuum. And I think we've kind of seen something similar through the pandemic, when all the people decided to work from home and all these things, and there are some parallels there. And I think what we've seen over the last year or two is this vacuum of demand kind of materialize, and I think that was the catalyst for the decline in the stock market last year in 2022, as you saw demand for all of these, the Magnificent Seven all saw revenue growth decline significantly, profits decline. And then we had this magic AI narrative that, essentially Satya Nadella got behind at, Microsoft, and created this boom in AI. What I think people don't necessarily appreciate about AI is that for what has made, I think, a lot of these companies successful, Meta, Alphabet, Microsoft, is the fact that they have been able to sell picks and shovels during a gold rush, right? I talked about before how we had this massive VC investment in startups, and all these startups needed to advertise on Instagram and Google and YouTube and all these things. They needed to buy cloud services from Google and Amazon and Microsoft, and they needed software to run their businesses. And so this huge VC boom created a boom for the Magnificent Seven companies. And it was terrifically profitable for them to sell to this, into this. But now, if you look at what is AI, and it's, for me, it's very interesting to see Microsoft rise today on the news regarding OpenAI, because, Microsoft, it's kind of, there's been some criticism, but I don't think there's been enough where of these big tech companies, where Microsoft says we're going to invest 10 billion, 15 billion into OpenAI, and OpenAI is going to turn around and invest that right in the Azure cloud. And it's essentially Microsoft's money going to OpenAI and right back to Microsoft so they can count it as revenue again. And it's legal. It's legal, but it's not necessarily, a sustainable business model to recycle your own cash into something that might not be sustainable without you. But so Microsoft bringing Sam Altman in-house to do AI turns it from selling picks and shovels to somebody panning for gold, OpenAI, to we're going to start panning for gold ourselves now. And it creates, we're going to be investing massively in AI, and it depresses cash flow, right? You're spending a lot of money instead of investing in OpenAI. You're spending that money in CapEx, and that to me is a fundamental difference. It's going from selling the picks and shovels to actually panning. And Google's doing the same thing. Meta's doing the same thing. Amazon's doing the same thing. And what we've seen since they've been massively investing just over the last year or two, free cash flow is falling at these companies. They all trade now 50, 60 times free cash flow. At the same time as free cash flow is coming down because their CapEx is going through the roof. So they better have a massive return on all this investment, because if they don't, right, these stock prices are going to be massively overvalued and they're not going to generate the profits to support them. So yeah, I think this whole AI boom right now, we're in the phase of everybody's all excited about what's going to generate, but if it doesn't generate the profits to support all of the CapEx, these companies are going to have a problem.
So there's probably no company that's sort of priced to fantasy right now as much as NVIDIA. And in the news that came out this weekend, which I'm still catching up on, but it seems that one of the projects that Sam Altman, CEO of OpenAI, was working on was kind of the Skunkworks project to get a whole bunch of funding to be able to create, basically a different type of competing solution to NVIDIA here, right? And basically come up with a better performing chip that underpriced what NVIDIA is doing, right? So to your point, like as all the sharks start kind of turning on each other, we have these companies that are priced at or near fantasy, and not all of them can be the winner take all victor here, right? So right. Just almost sort of by logic, a number of today's valuations are going to have to be regrounded at some point.
I think so. And I think investors are going to notice that the price to free cash flow numbers are really the way you want to value these companies. And when I say 50 to 60 times, I'm backing out stock-based compensation. I think that, a lot of companies add that back into free cash flow, but, the evaluation expert like Aswath Damodaran will tell you, that is a cost of doing business. It's not, shouldn't be added back to cash flow. So when you look at, the valuation of these companies, and I literally, when I say 50 to 60 times, I'm taking their total market cap and aggregating it, and then taking their total free cash flow from all 7 of these companies and aggregating it. And you got, 50 plus multiple. And the thing is that's so difficult is, right, a 50 multiple might be not a big deal for a small company that's growing 30, 40, 50% a year, the free cash flow. These companies are now free cash flows like flat or negative year over year. And the revenues are so
but also companies like Apple are negative revenue growth.
4 quarters of negative revenue growth for Apple. It's the worst in 2 decades, revenue growth for Apple. But it trades at its highest valuation since before they introduced the iPhone. So you have a huge mismatch here in terms of the valuation multiples and the real growth. And so this is where I think it's a very interesting time. Because you look at all these companies, they're starting to create the AI products that are going out into the marketplace. And so far, Microsoft is the only company that's been able to actually charge anything for it. It's not showing up really in their earnings yet because it's so small, but every other company, whether it's Adobe or any other Intuit, has said, okay, we're going to create these AI products, but we're going to just include them in the pricing. So it's not enhancing profitability. It's not creating more revenue. so far. But the valuations right now suggest that the AI boom is going to be massively profitable for these companies, just as the iPhone was when it was introduced, and just as cloud was for Amazon when they first started doing that. I think that is a really big risk, is that AI is not nearly as profitable as the markets currently price it out to be.
Okay. Well, I mean, I guess the answer is we're going to see, right? So, we'll be tracking it over the coming quarters and years and whatever. And Jesse, we'll have you back on a lot to kind of, tell us what you see on a play-by-play basis. I want to get to a few other charts that you put up because we're heading sort of towards a couple mega questions that I want to ask you about where the market's headed. Clearly, you're saying, look, the tech sector has got its concerns. And again, as I mentioned earlier, that's the sector that's been basically responsible for all of the indices gains, this year. So obviously, if that one stumbles, if there's no sector to step up and assume the torch, which I don't know, I don't really see one that's got that much market weighting ready to do that in the wings, but we'll see what you think. But still staying at this higher level of these three key points you mentioned. So you talked about geopolitics, where we're kind of reshoring and taking on the expense of rejiggering supply chains. Part of that too, and I don't want to get into it too much because we could talk about it forever, but there's sort of Zoltan Posnar's point about the rise of the BRICS as a trading bloc. And I'm not necessarily getting to the competing currency or whatnot, but just that they're going to be trading more with one another going forward than they have in the past, where in the past, the US and some of the big Western countries were kind of used to being first at the trough. Hey, we're going to be able to buy as much as we want from you at the best price volume discount. And the word that Zoltan uses is that commodities are going to become increasingly encumbered going forward, which basically means they're just being promised to other people besides us, right? So the US will probably still be the biggest buyer, but they'll show up and they'll say, okay, we want to buy X amount of this. And they'll say, well, we don't really have that amount for you. We're going to give you less. We've got some, but we don't have as much as you want. And because we've already done contracts with these other guys, and because there's more demand for it, well, your price is going to go higher than what it was. So that's just going to be inflationary, right? Along with the supply chain rebuilding. The other inflationary trend you talked about was the demographics, right? Where we had this glut of workers, both domestic and foreign, that really drove down the cost of production from a labor standpoint. Now that's going into reverse. Globalization is going into reverse, as we talked about, and the boomers are retiring, right? And we can also have sort of a side conversation too about how well skilled the labor force replacing the boomers are. But I think there's data out there that shows that it's not of the quality that the boomer generation was at the same age in terms of their ability to apply trades and do stuff. Interesting discussion. But again, that's inflationary. That just means fewer workers who are going to cost more. And we're already seeing that, right? I mean, coming out of COVID now, we've had a lot of unions stand up and say, look, we want to be paid what we're worth, right? So the cost of labor is going up, which is impacting the cost of production. So that's all inflationary. So where I'm going with this is this chart that you wrote about relatively recently, which is from John Hussman, who we talk about a lot on this program. But if we're looking at the federal debt expressed as mortgage payments over these periods of time, we see it going up pretty dramatically. I've got another chart here too about just the surge in the U.S. pile of debt here, right? These are annualized payments on the U.S. debt, and they have just gone ballistic. I mean, it's more than doubled in the past 2 years. And so, we've got this sort of financial side of inflation contributing to this too, as the cost of our debt just gets more and more expensive. So talk about the importance of these two charts.
Yeah, I mean, this is another dynamic that I've been watching closely. I think back in May or June, I wrote a piece for my subscribers called The Most Important Chart in the World. And I was talking about the 10-year Treasury yield. It looked to me like it was getting ready to break out higher. And that really fit very closely with a macro narrative that I was tracking that really came from the likes of Ray Dalio, and Bridgewater has been talking about a quote unquote liquidity hole. And that's essentially just the fact that the supply of treasuries is growing so much faster than the demand for them, right? We've seen demand from foreigners for treasuries has, at least plateaued, if not kind of rolled over. At the same time as the Fed has gone from a major buyer to they're not selling, but they're not reinvesting. So you have demand that's fallen significantly for treasuries, while supplies are just literally growing exponentially. We're at the point now where we're having to sell new debt just to fund the interest on our debt. And I think Dahlia was again on CNBC last week saying, this is the acceleration point. This is the point of no return, essentially, where the debt growth starts to accelerate. And
Right.
for me, it's just a hedge fund guy. You can say, okay, well, maybe he has an agenda. But when you have Bill Dudley, former head of the New York Fed, who's been writing all year, since the very beginning of the year, that he would be surprised if we didn't see turbulence, was the term that he used, in the treasury market based on the supply-demand mismatch. And you have, Larry Summers, former Treasury Secretary, talking about the potential for a debt crisis. So when you have, Paul Tudor Jones has warned about this recently also, that all of the smartest people in the markets and even on the government side of things are suggesting that the fiscal policy is reaching kind of this point of no return, where the debt growth is going to start to spiral. And I think that is another dynamic that's really important to pay close attention to, because I think at some point, the Fed can only do so much, right? What's going to happen, I think, is the bond vigilantes are going to have to send a very clear message to the federal government that this path is not sustainable, and you're going to have to make some major changes in terms of spending and in terms of taxes in order to kind of bring this, create a fiscal plan for kind of getting the house back in order. But I think it's going to take market signals to kind of make that happen. So I do think there's potential for higher long-term interest rates over the next several months and quarters, just due to this supply-demand mismatch. And I think that's a really important dynamic that fits along with these other things that we're talking about.
Okay, gosh, so there's several things sort of wrapped up in there. So kind of at the core right now is the supply issue, right? You're saying, demand for treasuries not really budging all that much, but supply is going through the roof, right? Part of that is because of, part of it happened because we had to refill the TGA. I think that's refilled, but I actually don't know. Do you know, is that part of the treasury issuance done?
It's yes. I think it's back to 700 billion or something like that. So it's,
Okay.
yes, it's probably mostly there.
All right. So the remaining issuance then is just to fund the deficit spending that's been going on this year, right? Which is, from historical precedence perspective, extremely high. It's extremely high percent of GDP. I've talked about this a lot on this channel, particularly in an era like this where we're not at war. And I know some people tell me, well, hey, we're funding these wars. Yeah, okay, we're contributing to some, military operations, but we're not at war like we were at World War I or World War II. We were committing troops and we were rejiggering our economy about, manufacturing war material and stuff like that. But the only other times in history where we've been this high a percent of GDP, we were in like World War II. So historically aberrant levels of deficit spending. So I guess that's what's responsible for the rest. So like, I guess game this out for us. So the vigilantes the bond market will increasingly demand higher and higher yields as it gets more and more concerned about this. I guess one of two things has to blink, right? You're saying we're kind of near this inflection point. And I want to dig into are you worried that we're at a point where like the debt crisis literally just becomes a runaway conflagration here? Or does it act as a throttle in the system, like they say sometimes for inflation? The cure for high prices are high prices. The cure for this type of stuff is just debt gets high enough that, the economy just slows enough, or the markets crash. You said this is going to be solved by market signals. So I guess what do you expect to happen here?
Yeah, I mean, it's hard to expect anything because we haven't gone through this. But if you look at what's happened to kind of other countries throughout history, and this is kind of, I think, what Ray Dalio's pointed to, is you just get to a point where something has to change, and so I think we're probably going to get to that point where market forces, the, it's hard to know exactly what's going to happen, but I think I'll just kind of point to what Bill Dudley has pointed out. Is that he's used the term turbulence in the treasury market, and that's basically just there's not enough demand and there's a lot of issuance, and that's why people are paying close attention to these treasury announcements and treasury auctions and things, because we just had a terrible 30-year auction a week or two ago. And that's a sign that that these narratives are more than just narratives. There is a supply demand mismatch there, and so I think probably what we're going to be heading towards is a time where you do see very poor auctions of maybe a failed auction. You see spikes in longer term interest rates, and it's going to have to be addressed. The Fed. It's very dangerous, right, for the Fed to kind of step into the treasury market at this point when inflation expectations are already elevated, because if people lose faith in the Fed's commitment to reining in inflation in a sustainable way, inflation expectations kind of get out of control, and then that's how you kind of get into an inflationary spiral, and that psychology takes off. That's the Fed's worst nightmare. So the Fed really would not want to have to be the one to do something, which I think is why Jay Powell's like, we're not going to intervene. And if long-term interest rates go up, so be it. I think he probably understands that that's the signal that Congress may need to say, this can't go on, right? If 5% on the 10-year doesn't wake you up, maybe 6% will, maybe 7% will wake you up and let you know that, okay, something has to change. Now, I think people buying treasuries today are still operating under this old framework, right? They're still operating, they're not thinking about this sea change. So in terms of how these debt dynamics work, I think what people don't necessarily think about or appreciate is if we go into recession, the $2 trillion deficit, what happens to that, right? Revenue comes down even further, right? And so you get 3, 4 trillion. And so the supply of treasuries is going to explode at a faster rate once you go into recession. So everybody who's thinking that, okay, recession means economy is going to slow and interest rates are going to come down, could be in for a major surprise if recession actually means deficit blows out even wider, treasury supplies grow dramatically, and interest rates actually go up in the onset of recession. That's the thing I think I'm worried about the most right now.
Okay, and that's exactly where I was taking this. So thank you for bringing that up. So we've had, I would say with the people I've talked to recently, there's a lot of signals that they're seeing in common. But one of the areas where people are diverging is on where they think inflation's headed. We have some that are, like you, I think, saying, hey, it could be stickier than most people realize, right? And then we've got people like David Rosenberg, who I interviewed a week ago, who basically is expecting a one handle on CPI by the end of next year, right? But another one is bonds, and those are somewhat
I don't necessarily. I just want to point out, I wouldn't necessarily disagree with Rosie. There's the cyclical forces of inflation, right? Now, cyclically, from a cyclical perspective, inflation is coming down right now, for sure. I don't disagree with that, and I don't know how low it'll get. It might get down to below 2, but I think my point is over the next 5 years, 10 years, we're probably not going to stay below 2.
You're right, and that wasn't fair of me to compare the two of you.
No,
Because you are talking about the secular sea change here, where Rosie in the conversation was talking about the next 12 months. So
yeah.
So that wasn't an apples to apples comparison. So I'm glad you chimed in with that. But I think there are some people that still have that aren't on the secular inflation rise yet, and then bonds in the near term. that's one of those other areas where I'd say, I don't know if it's 50-50, but there are definitely some that are saying most attractive time to buy bonds that I've seen in my career. This is the time to go out in long duration US Treasuries in advance of a recession coming or something breaking under this high cost of capital, which we haven't even talked about yet, right? And Fed has to intervene. And all of a sudden, the biggest buyer of treasuries, who's been sitting on their hands for the past year and a half, is all of a sudden back buying them. And there's the crisis trade, where the fear trade, everybody's piling back into treasuries. So there's definitely that argument that says, hey, looking out for the next 6 to 12 months, US treasuries look really attractive. Then there's the argument that you just made, which is like, might not be the time this yet. So it's very helpful for people to have, a clear understanding of what each side is using to rationalize this position. I appreciate you taking the time to do that.
Yeah. And I would just say, too, that if you do think the Fed is going to pivot and have to intervene in the Treasury market, I do think we're probably headed for yield curve control over the next several years, right? Because if you do believe we're on an unsustainable debt path, the Fed will be forced. I mean, I think we've already been in, an era kind of fiscal dominance for years. If you just look at the trajectory of debt to GDP and the Fed balance sheet to GDP, they mirror each other almost perfectly.
Mm-hmm.
And I think that was the first sign to me that, okay, the Fed is now subservient to the needs of the fiscal authority. That I think will get more obvious in the next few years if they're forced into yield curve control. Like, okay, we literally cannot service our debt at a 6, 7, 8% interest rate. So Fed's going to have to pin them somewhere lower. But if you believe that's going to happen, right, your bonds, maybe you're going to get pinned at 4 or pinned at 3 or something. That caps your upside is very limited. But if the Fed does that, even while inflation is high and fiscal issues are a problem, I think a much better trade is probably precious metals. Is that, the gold price goes to the moon in that scenario. I don't think you can imagine a more bullish scenario for gold than that type of a scenario. Now, I think Jay Powell's going to be really, really reluctant to intervene in Treasury. He's going to do everything he can to avoid intervening in treasuries because he understands that inflation psychology may be the most important thing he has to try and manage.
Right.
So he cannot make it look like the Fed is going to do anything other than bring inflation back under control. But if he is forced to pivot for some reason, and maybe that's because interest rates are kind of getting out of hand on the upside, that means very dollar bearish and very, very bullish for precious metals. So I think if that is your scenario, that you think recession is going to happen, the Fed's going to pivot, you should probably be buying precious metals instead of treasuries.
Okay. I know you gave a little nod earlier to hard assets too. We're going to return to that right as we begin to wrap things up here. But this topic about, what happens in the currency in this type of future that you see coming, right? I think you just made some very important points there. Going back to Hussman for a second, he said the following. He was quoting economist Peter Bernholz and said, and I'm a little loath to bring this up because it's a bit of a charged term, but it in some way captures a little bit of the spirit of what you're talking about. And I'm curious kind of how big a risk to the purchasing power of the currency you see going ahead in the sea change of the next decade or two. But Bernholz's quote was, "In all cases of hyperinflation, deficits accounting to more than 20% of public expenditures are present." Now, you noted that we've exceeded that level in each of the past 5 years, right? So I hate to use the word hyperinflation because everybody starts thinking about, oh my God, we're going into Zimbabwe or Weimar Germany tomorrow. But if we just think about it as a challenge to the purchasing power of the currency that we have, how worrisome is it that we've been above this 20% of public expenditures threshold for the past half decade?
I think the best thing that I would point to is, I don't know. I mean, I think it's basically it's interesting to point out that this is a condition, right? The condition is there. That doesn't mean it's actually going to happen. It means the window is open to that type of a possibility. And all I would say is that there are a lot of smarter people around the world that are reacting to this than me. And I'm talking about foreign central banks. What are foreign central banks doing? they're buying gold
They're buying gold.
against the risk that this type of a scenario unfolds. And that's not saying they're betting on it happening. They're just saying that if it does happen, I want to be prepared. And so that's why you're seeing record gold buying by central banks around the world, and even some foreign central bankers talking about we might have to go back, because the monetary and fiscal policy has been so insane over the past few years. They might see a future. I think it was, I can't remember which central banker was talking about this, but it was head of one of the smaller ones, saying we might be headed for a new gold standard at some point over the next several years.
This was
And if that's the case,
Holland,
we want to be prepared, which is, we want to build up our gold reserves now, again, to prepare for that type of an outcome. Those are all the possibilities for where we're headed. I don't think it's possible to forecast how any of this unfolds, but I do think the risk is there.
Okay, and that's kind of where I was going. By the way, I think it might have been the Dutch central bank that made that announcement. But when you talk about yield curve control, you talk about the threats to the purchasing power of the currency that we're raising here. That's sort of what I was looking for, was like a finger to the wind. Like how concerned should the regular investor be about this? And what I hear you saying is you're concerned enough to be putting some percentage of your portfolio into a real asset or something that's likely going to hold its purchasing power better in an inflationary regime.
Yeah, absolutely. And I would just point out that, you suggested that, the deficit to GDP right now during an economic, we're 8% or something, fiscal deficit to GDP. In the 1960s, that went to about 2.5% of GDP. And that was the late 60s. That was kind of the foundation for the inflationary decade of the 70s. So, if 2.5% of deficit to GDP, I'm talking about during an economic expansion, right? You expect the deficit to blow out during recession. Normally, the way that, monetary and fiscal policy work is that, when economy is good, the deficit narrows. And that's kind of when we kind of prepare for a rainy day. What we've been doing during this economic expansion is just the opposite, where we've seen the deficit just blow out dramatically. And so I do think that the risk is there, and it's probably greater than it's ever been before for a debt crisis and a persistent inflation problem for a prolonged period of time.
All right, so you're raising warning flags about secular inflation from here, the potential unfolding of a debt crisis. Here we are, we're at a period of time where the market is richly valued. This basically is contrasting the PE ratio of the S&P with Treasury bonds, and basically showing that stocks are quite overvalued compared to bonds. And one of two things has to happen, which is stocks have to come down in price, or bond yields have to come down. Maybe both. Who knows? Maybe they meet in the middle or whatnot. But you have this other chart too, which shows that the concentration of gains amongst the biggest stocks that we're seeing right now is something that typically happens at the end of bull markets, not the start. So are you also basically kind of throwing a market correction into the mix of risks here?
I think it's bigger than a correction. I think, we've been in a bear market since early 2021, really since that meme stock frenzy with GameStop and AMC and stuff. And that was really in early, I think, February, March of 2021. And that was a speculative mania like we've rarely seen, around the world. I think we saw it in 1999. We saw it in 1929. We saw it in Japan in the late 80s. But we saw, when people were trading stocks the way that they were, and cryptocurrencies and all kind of the craziness, and even still with the single day, 0-day options and these types of things, the way that those always unwind is in a speculative bust. And 2022 was, I think, just the beginning of that. Jeremy Grantham is probably the best most experienced and knowledgeable bubble watcher that I've ever seen, and very good at calling these things. And, he said he studied, I don't know how many dozens of bubbles around the world, and every single one of them has deflated to, kind of at least a normalized valuation ratio over time. That would take, the S&P 500 back down. I mean, that's why I'm really glad you showed that chart between interest rates and valuations, because if interest rates stay where they are, valuations have to come down a lot. And so this is probably the best chart to show investors betting on a soft landing. Investors are betting on interest rates are going to come back down to 2.5% without a recession, right? Because if rates come back to 2.5% because of a recession, corporate earnings are going to tank, and the valuation, will be even much higher than it is. So yeah, I mean, there's a few different ways that gap closes, but the way that markets are betting today, that interest rates come down without a recession, is probably, I think, the least likely of all of them. I mean, valuations, if you don't get a recession, valuations probably start to normalize towards that lower level. But I think it's probably most likely that you get a combination closure there, where you do get a recession, get interest rates come down potentially a bit, and valuations have to come down a lot, and stock prices actually have to fall faster than valuations because earnings are falling in that scenario too. So I do think we are in a bear market that is almost 3 years old now. In early 24 it'll be 3 years old, but probably has a ways to go before the stock market fully unwinds the speculative mania that we saw a few years ago.
All right, I just interviewed Ken Oakley. That interview is going to air after this one, Jesse, but he shares a similar viewpoint of view on that. And he says, all bear markets end in capitulation, and there's kind of a washout, a flushing that happens at the end of bear markets. And he just said, we didn't see any of that in 2022. There was no capitulation in that sort of orderly market decrease. Obviously, things have reinflated here in 2023. So he's expecting at some point, but probably next year, to see that bear market capitulation. Sounds like you're sort of expecting similar.
Yeah, I do think bear markets always end in panic, and what I worry about most today is that we haven't seen that panic yet in the bond market, right? And so if the bond market still has pain ahead of it, right, that means interest rates are still going even higher, and that valuation, the gap between equity valuations and interest rates, gets even wider and creates even more pain for the stock market. So I don't think we've seen capitulation yet in the bond market.
In the bond market.
And so if we are in this kind of new inflationary regime and a secular inflationary regime, you may need to see some capitulation in bonds before you can even think about stock prices have actually done enough to reflect the new reality.
That's so interesting for two reasons. One, bonds have never had, at least treasury bonds, have never had 3 consecutive down years since ever, since we started keeping records at the end of the 1700s. They're going to have that third year this year, it looks like, unless something miraculous happens. What I hear you saying is there maybe could be a fourth year. Who knows? I mean, maybe we capitulate and recover next year too, but it could get even worse, is what I hear you saying.
Yeah, no, Med Faber has a great study though, where he's looked back at every single asset class, and when they have 2 down years in a row, returns going forward are usually pretty good. 3 down years in a row, returns are pretty good. You rarely see 4 in almost any asset class, but I think it was in 2015 that I wrote a piece kind of highlighting his research about, gold price, I think, had been down 3 or 4 years in a row in 2015. And since then, it's been, great to be an investor in precious metals. I don't know if we're in for another down year for bonds. What I worry about is more that scenario, kind of like we saw in the UK, where you have, some volatility in the market, spiking kind of interest rates that create some type of an intervention. And I think that we're probably headed for something like that. And I can't imagine that stock prices would just kind of still be on soft landing nirvana
Shrug it off.
with that kind of turbulence in the treasury market.
Okay. All right. I was going to ask a question, which we don't have to get real into, but is, obviously if interest rates go even higher, and I know you're expecting kind of like a break moment, or, it's going to be violent but short, right?
Yep.
But if interest rates kept going to 6+ or whatever, right? I mean, there's a good argument to be made that the U.S. economy can't sustain a cost of capital where we are today, right? And that we're just waiting for the lag effect to catch up with us, right? I mean, at 6+ or whatever, my brain just has a really hard time seeing us being able to sustain any of that. I assume you feel somewhat similar, but maybe not.
No, absolutely right. I mean, I think we're already at a point of interest rates, right, where the housing market is starting to like shut down, right? And I mean, prices are still elevated because there's no supplies, but fewer and fewer people can afford to buy a home. You look at the small business surveys, and they're all saying we can't afford to take out new loans to invest in anything. And small business is usually a good leading indicator for big business because, like Facebook has said, the majority of their businesses is selling to small business, and that's true for so many companies. And so it's a good leading indicator. And small businesses are very clear that they've been suffering, and they're worried about their ability to sustain business over the next several quarters. So yeah, I think we're already at the point where interest rates are doing damage. Further spike in interest rates, especially because, and I just make this final point, that so many CFOs, Fortune 500 CFOs, right, have debt that they need to refinance over the next year or two. And they're making the same bet as this soft landing group that, okay, if we just hold off as long as we can, right, interest rates next year will be lower. Okay, now we can refinance our debt. If that doesn't happen and interest rates are just where they are today or even higher, then you're going to have a real default cycle in corporate credit. And so, if interest rates go up instead of, as CFOs anticipate, coming down, then you have real problems, and that obviously ripples through the economy.
Yeah, that'll be the barrage of silver bullets that takes down all the zombie companies that have been able to limp along right now. Yeah. All right. Well, look, Jesse, we're here at the end of the hour, and I mean, I could just talk for hours and hours with you. So we're going to have to start landing the plane here. Last big question before I just wrap everything up, which is, okay, so you've just, sketched out for us in detail these concerns you have both about the next 5+ years, but also, a lot of those shoes are going to start dropping from here. How do you think the prudent investor should consider positioning for this? Are there assets that you particularly like in this environment? Are there ones that you wouldn't touch with a 10-foot pole? Sounds like you wouldn't be going long bonds right now, given your outlook.
No, and I would just point out that historically, he's not known for it, but Warren Buffett has been one of the best bond investors, for the past 40+ years. We're leading into recession. When he's built up cash at Berkshire Hathaway, he's invested a lot in zero coupon bonds, anticipating the interest rates to come down. He owns no zeros today. It's all short-term treasury bills. That to me is a clear sign that he kind of shares my concerns that hey, it's great to get 5% short term, but there's really no reason to kind of invest longer term. I think the key for investors today is be conservative and diversified, right? I think a lot of investors are far too heavily invested in equities, in U.S. equities in particular. Foreign equities are generally much better priced in terms of valuations. But I think a lot of people don't think about diversifying across multiple asset classes, right? If they do, they own the 60-40 portfolio, 60 equities, 40% bonds. But that leaves a huge category out of the equation, which is real assets. And I think this is maybe the key thing that I would hope people take away from this is that it's been fine if you've been underinvested in real assets for the last 10, 15 years. But if you're historically, if you're underinvested in real assets, you go through very difficult periods in your portfolio, like you did through the 1970s, where inflation just ravishes financial assets, the value of financial assets in your portfolio. And if you don't have something to offset that in that type of a difficult environment, like real assets, then the portfolio suffers. And so in terms of real assets, I'm just pointing out things like precious metals, commodities. I think I like tips, inflation protected securities, and even real estate to an extent. Obviously, commercial real estate is pretty dangerous today in terms of offices. I don't know how much of that is effectively priced in now, because it's become such a small sector relative to the others. And residential may have problems of its own, but I think one thing that people don't necessarily appreciate about residential is we did go through a capital cycle there too, where we had the real estate bust in 2008, 9, 10, 11, 12. We massively underinvested in residential real estate. And so now, that the prices that we're seeing in real estate are the result of that underinvestment. And so until we get back to a cycle of massive overinvestment in residential real estate, like we saw in 2004, 5, 6, I don't think we're going to see a major top in residential real estate values. So real estate is just part of that larger framework. But I really think commodities and precious metals, adding those things to the portfolio to just add to the diversification, is really critical.
All right, and I just put up a chart here, Jesse. I hope you can see it. But again, I pulled this from your Twitter feed this morning. This is basically a chart that says, hey, look, when looking at real assets, if you want to look at the historical ebbs and flows of that sector, it's definitely been at a nadir, and it actually maybe looks like it may have hit a bottom there in 2021. And if it indeed is on a secular upswing here, there's a far way to go just to get to the historic mean.
Oh, yeah, absolutely. And this is why I've been kind of pounding the table for a few years now that we are in the early stages of a commodities super cycle. Because, if you look at that, real assets have never been cheaper in 100 years than they are today. Right? There's still, even after the performance that we've seen in energy stocks and in oil prices and in precious metals over the last few years, really since, like I said, 2015, it's barely made a dent in this. And so I think, when you just think about real assets are still cheaper relative to financial assets than they've ever been before in history, it makes a lot of sense from a fundamental standpoint, not even from, ignore all the macro stuff that we've talked about today, just from a valuation fundamental standpoint, makes sense to have an allocation there. And then if you do believe any of the kind of macro arguments that I've made today, then you think that, that recent uptick probably has a very strong tailwind that lasts a number of years.
All right. Well, Jesse, look, like I said, I'd love to keep on going, but I got to be respectful of you and your time. For folks that have really enjoyed this conversation and would like to follow you and your work, where should they go?
I try and put up a blog post once a week at thefelderreport.com. That's also where I write a weekly market comment for my premium subscribers and specific trade ideas, typically on a weekly basis, in a weekly chart book, running down kind of the trends and things that I see across a multitude of different markets. I'm also fairly active still on Twitter. It's just at Jesse Felder. Looking for an alternative. So if you have any blue sky invites for me, Adam, I'm hat in hand looking for an alternative. It's a shame to see something that's been so valuable to me. To meet people like you through Twitter and Fred, and it's been a wonderful place to do that. But it seems like it's kind of gone the wrong direction the last year or so. But still, I find a terrific amount of value. So I'm still reluctantly very active on Twitter at Jesse Felder.
Okay. Yeah. And to your question about Blue Sky, I heard about it from you, Jesse. So I put my name in for the
All right. When I get some invites, I'll send them to you.
Okay. Whoever gets one first. But I'm sure they're probably coming to you before me.
Okay.
All right. Well, look, this has been fantastic. Folks, if you'd like to thank Jesse for coming on the program here and giving so much of his time to us, but also give him the encouragement that when the next big thing appears in his radar, that he reaches out to me and says, "Hey, Adam, I'd like to, blast this news out on your platform." Please encourage him to do that by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. And because this channel, Thoughtful Money, is still in its infancy here, our subscriber count actually really does matter. So if you are watching and haven't yet subscribed, please just take a second, make sure you hit that subscribe button, that little bell next to it. It's going to help sort of amplify how brightly we burn on the YouTube algorithm, and that determines how many new people that these videos get shared with. Also, just a reminder for folks, in terms of Thoughtful Money, what we're doing with this platform, the guests that are coming on the program in the future, and there's a great, huge list of just wonderful minds lined up here. I'm increasingly giving updates through my new Substack on that. If you haven't signed up for my Substack, it's totally free. You can do that over at adamtaggart.substack.com. All right, Jesse, I'm going to let you have the last word here. Any bits of parting advice for today's viewers as they go off and try to figure out how to navigate this very challenging future you just painted for us?
My only advice is subscribe to Adam's channel, because I'm a big fan of what you do. I love listening to all the interviews that you do, and it's just been an honor for me to do this. So thanks for having me.
Oh gosh, the pleasure is mine, Jesse. And folks, hey, just a reminder, if you haven't watched it yet, the last video before this was the long-awaited, it wasn't really a debate, but the co-exploration of the future of the dollar between Brent Johnson and Matthew Piepenburg. And if you haven't watched that, that would be a great video to watch after that one. I'll put up the link to it right here. You can check that out next. Jesse, thanks so much. Everybody else, thanks so much for watching.